Well, personal finance expert and director with Galileo Capital, Warren Ingram, joins us. Warren, good evening.
Hello, Ray.
So, all right, let's be sensible about where we're going to put our money. Tell us more.
No golden geckos, please.
No, you don't want that. You see, there's an honest way of doing this, isn't there?
There's an honest and much more sane and predictable way of making money than trying to make it in days or weeks or months, which is almost a surefire way to lose it all.
All right, so how do you make it? I mean, you have these guys on their laptops and they go, sell, and they've just made $5 million. Is it really as easy as that? No,
definitely not. And I think that, it's amazing what kind of what movies and I guess TV have done to the image of moneymakers, and thinking that it's that easy. So I think on the one side, you always need to understand the eighth wonder of the world, which is compound growth. And just to try and explain that really simply, that's when your money starts to generate growth on its own. So in other words, let's just say you've got 100,000 rand that you've managed to accumulate, and you put it away and you invest it, and it grows at 10% a year. With you doing nothing, your 100,000 rand has suddenly become 110,000 rand, and in the year after that, it's probably 121,000 rand. And it doesn't take long before your 100,000 is 200,000. And that's without you adding money to it. It just starts to grow on itself. And the longer you leave it, the bigger that growth gets. And that's really the most important thing to understand about investing is it always takes an incredibly long time, and it almost sometimes seems impossibly long time for you to make your first amount of money, your first big lump sum. And that really is going to come from you saving and building up a little bit over time, every day, every month, every year. But what happens is once you've got that lump sum, that's when investing starts to become a little bit more easy, a little bit more predictable, because then you get this power of compounding working in your favor. And that's really the whole trick to any kind of investing, whether it's in shares or residential property or other kinds of property or even in a business. It's about sometimes just being patient and letting that capital accumulate on itself.
Yeah, because it's quite difficult sometimes, isn't it? You have that little bit of capital, or maybe your savings, and you go and you put that into a share, you buy something, I said earlier on Satrix, and then you don't see it really grow, you lose patience, and you want to take it out.
And I think that's probably the real danger that I see at the moment with people that have been investing, let's just say first-time investors that have been in the market for the last 3 to 5 years. Because if they've bought something, like a Satrix, and there's really, Satrix, is nothing wrong with it, especially the kind of a more generic one, the top 40 index, and it's not just Satrix that makes those products. There are quite a few product providers that offer exchange traded funds on the index, and the danger is that you've seen almost no growth for that period of time, the last, let's say, 4 or 5 years. And I think that's really the danger now, because people start to look at adverts from the bank saying, you can get 8% interest a year, and then, they're looking at their statement and saying, I got nothing like 8% a year from my shares. And, those guys on the radio have been telling me that shares are a good place to get money, so why am I doing it? And I think that's the danger, and always in a situation like that, I always want to try and make people kind of zoom out a bit and just look a little bit longer term. And just as an example, if you'd been in the JSE for the last 8 years, and let's just say you've been lucky or clever or disciplined enough to put 100,000 rand in the JSE 8 years ago, and truthfully, did nothing more clever than just buy the top 40 index. Yeah. The likelihood is that your money's gone from 100 to 191,000 rand over that 8-year period. And if we think about the last 8 years, it's hardly been a great time in the South African economy. We've had Zoomonomics going full bore, doing its best to kind of erode the value of our country's economic growth. We've had consumers really struggling, retailers really battling, lots of them either going bankrupt or pulling out of the country. But your money's nearly doubled over that 8-year period. And that's the trick with investing, is you've got to be able to kind of zoom out and look at the longer term. And I think also we can't be scared by volatility or bad news. In volatility, you often hear that, market commentators saying market was really volatile, a lot of times people don't understand what that is. But that's really just when you're looking at your statement and it's gone from 190 down to 180,000 rand, and then 170, and suddenly people saying, I can't handle these losses anymore. I want out.
Yeah.
And what's amazing is we almost do it as that kind of one big herd. When you look at the stock market, to me, it's just one enormous herd of people often acting irrationally over short periods of time. And last week was a classic example. If I'd said to you on Monday morning at 8 o'clock last week, Ray, we're going to have the best week in the last decade on the JSE, you would have honestly thought I was smoking my socks.
You're quite right.
On Monday morning last week that would have told us that that this would be a fabulous week in the markets. And the truth is, it was literally that. It was the best week in the last decade, and that was a return that investors needed to be in to get that 191,000 rand. And that's the whole point about this is trying to look ahead and say, oh, I know what's going to happen, or I'm listening to those guys on the radio and they know what's going to happen. The truth is, no one knows what's going to happen in the next week. We can sound really clever about what we think is going to happen and what interest rates are going to do and what Trump's going to do and what the elections are going to do, but the reality is we don't know. And so to make a long-term investment decision based on what you or I think is going to happen next week or next month, or the new favorite is what's going to happen in the elections in South Africa, and is that going to be in April or May, and that's such an incredibly short time frame to make an investment decision that I think it's kind of a waste of time actually to worry about that. You really have to take a longer term view. SMS
here just says, Ray, what about short-term investments? And I must admit, every single day I look at the shares going up and going down, and can you not maybe read the markets? Let's take Clicks, for instance. I remember about 2 weeks ago, Clicks just shot up 5%. And I thought, wow, I could have made some cash out of that.
Yes, so that's the nice thing about investing is it's always easy in hindsight, and that's the problem is let's use that Clicks example. To try and anticipate what's going to happen there. First thing is you need to anticipate that there's going to be some kind of positive news that that's going to come to the market about Clicks as an example. Then you need to anticipate how the market's going to react to that and to what extent it's going to react to that. And then you need to be in the share at least a day before that positive news is released so that you can profit from that decision. And I think nowadays that's an incredibly, not incredibly difficult. I actually think that's an impossible thing to do. Very often, unless there's some kind of illegal inside information, we don't even know what direction things are going to go. And so, to me, worrying about short-term gains is really a good way to lose money. And I think, we've been given an absolutely brilliant example in the last, decade, from a so-called investment called Bitcoin.
Yeah. Oh, yes.
No one's talking about Bitcoin anymore, and the reason no one's talking about it is because it went down, and now it's gone nowhere for a few months. And I think the point there is that that's something that people got really excited about, how and kind of started to brag on Facebook about how they'd become millionaires on their Bitcoin overnight. I think guys were even writing books about how they were making money out of Bitcoin. And truthfully, they can claim no skill, no credit about being able to forecast how that was going to work. That was something that that might have a long-term technological benefit for society and for the financial services industry and many others. But to be able to say, yes, I knew exactly what Bitcoin was going to do, and I could put it on a graph and figure it all out, that's just garbage. And the reason I know that is, look at what happened to Bitcoin. In the last few months of last year, it almost went up in a straight line and peaked at an incredible price. And I think it was about $20,000 a coin. Yep. And then, nowadays it's kind of at 6,300, 6,400, and it's been there pretty much since January. And people who were buying in at $18,000 or $19,000 thinking this was a short-term way to make a fortune, well, they found a very short-term way to see their money go down by, 2/3. And short-term thinking is really dangerous for for a rational investor.
I've just gone to the Bitcoin desk as you were speaking. 6,450 on the Coinbase. That's what they say. So you're quite right. That's a way off 20,000. But that's also a fad as well. I mean, very often it's like a pyramid scheme. It's great for the first guy that gets in, not so much for the last guy.
Yes, and I think that's the point. If we're talking about investments, then that's not investing. That's really, in the purest form, speculation, where you're buying something with the hope that you'll be able to sell it to someone who's more gullible, if you want to be unkind, or has greater faith in whatever it is that you've bought than you do. And what's really dangerous is when that sort of cycle starts to go into a bubble phase, which is exactly what happened there. People are borrowing money out of their mortgages. They're using personal loans or credit cards, and they're buying the stuff, saying to themselves, if it costs me 10% interest for a couple of months, that's okay, because I'm going to make 100%.
Yeah.
And just think about that now. Those are people borrowing money. Let's just say they borrowed $18,000. Put it in a Bitcoin, and that Bitcoin is now worth 6,300, and they're paying massive interest on short-term debt, and got something that if they sell now, what they're going to get such a small amount of value out of that, but they've got the debt.
Oh, we need to talk about the small personal finance expert and director with Galileo Capital, Warren Ingram. Great to have you back.